The global long bond yield has just hit its highest level in nearly 20 years. You clicked on this video because you are worried about what that number means for your wallet right now. The real problem is that everything you learned about investing over the last 15 years is suddenly wrong. By the end of today, I will show you why holding on to cash or sticking with old bond strategies is no longer a safe harbor but an active loss machine in this new environment. Let us start by understanding what actually happened to these rates. For more than a decade, we operated under a strange assumption that borrowing money would remain incredibly cheap forever. That era ended abruptly. In early 2021, the 10-year United States Treasury yield surged nearly 80 basis points from its previous lows to reach multi-year highs in just a few months. This was not a random blip or a temporary glitch in the system. It marked a fundamental reset of what economists call the risk-free rate. Here is the thing that most people miss about this shift. The 10-year Treasury yield has traditionally been viewed as the baseline for all future returns, the floor upon which every other investment decision rests. When rates were at 0 or 1%, investors could safely park money in cash and expect to lose very little purchasing power over time because inflation was also low. But that relationship is broken now. Because of a convergence of surging inflation expectations and higher real yields, plus an expanded term premium where investors demand extra compensation for the uncertainty ahead, we are looking at a structural repricing rather than a temporary fluctuation. This brings us to the first critical insight you need to grasp today. The risk-free rate is no longer just a floor for valuation models or a safe place to hide your money until better times arrive. It has become a moving ceiling that invalidates every legacy discount cash flow assumption built on sub-2% rates. If you are an investor, business owner, or even someone planning their retirement based on old data from the early 2010s, those numbers simply do not apply anymore. The cost of capital for everything from housing to infrastructure projects has reset to a level where only high-velocity projects with immediate returns remain viable. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Now consider this complication that makes things even more confusing for the average person trying to make sense of their finances. While these yields are rising, inflation expectations have remained surprisingly anchored despite the massive spike in bond rates. This suggests that the surge is driven less by runaway hyperinflation and more by volatility in market mechanics and supply-demand imbalances. The International Monetary Fund has noted that while yields reflect fundamentals, liquidity can evaporate during times of stress, causing yields to rise excessively relative to underlying economic conditions. This nuance changes how you should think about your money right now. It implies that the danger is not an immediate collapse in purchasing power due to prices doubling overnight. Instead, the primary threat comes from opportunity cost and structural shifts in how capital is allocated. When liquidity dries up during stress events, yields can distort themselves upward, creating a scenario where you are forced into positions that do not reflect true economic growth, but rather market fear. This means your strategy cannot be static or passive anymore, because the baseline for returns has become volatile and influenced by complex market forces beyond simple supply and demand curves. Let us talk about what this actually costs you in real terms if you continue to hold cash or traditional bond portfolios. The divergence between rising nominal yields, which are climbing rapidly, and persistent inflation means that holding onto your savings is now a guaranteed negative real return strategy. You might see the dollar amount of your account grow slightly due to higher interest rates on new bonds, but because those rises have not kept pace with the actual erosion of purchasing power caused by inflation, you are actively losing ground every single day. Waiting for better rates becomes a failure mode that systematically erodes capital preservation strategies rather than protecting them. This leads us to the most important realization regarding your long-term financial planning and asset allocation. The historical conundrum where long-term rates stayed low despite tightening cycles is now resolved by a complete macroeconomic reassessment of risk. Engineers, architects, and business leaders can no longer rely on cheap debt to fund speculative research or development projects because that era has ended. The baseline cost of capital has reset to a level where the only way to survive financially is through high-velocity execution with immediate returns rather than long-term speculation funded by inexpensive loans. You might be wondering how this specifically impacts you as an individual investor trying to secure your future. The surge in longer-term yields signals a structural shift that necessitates moving from fixed-rate debt financing toward variable-rate hedging strategies if you are carrying significant obligations. Without these adjustments, projects dependent on long-horizon timelines face genuine insolvency risks because the cost of funding operational expenses is rising faster than the ability to refinance at stable rates. The 5-year yield component of this surge indicates that near-term costs are accelerating quicker than long-term debt structures can support, creating a liquidity squeeze for anyone relying on rolling short-term financing rather than locking in long-term bonds. This creates a dynamic environment where your asset allocation strategy must evolve from being static to becoming fluid and responsive. The new baseline is not just higher, it is more volatile and influenced by market mechanics that change rapidly based on central bank balance sheet normalization and fiscal uncertainty. You cannot simply buy and hold the same bond funds you used for decades because those vehicles are designed for a world where rates stay low, which no longer exists. The ultimate takeaway here is that your financial future depends on recognizing this new reality immediately. The risk-free rate has fundamentally reset to act as a mandatory baseline that invalidates legacy strategies built on cheap money. Holding cash or old bond portfolios is now a losing move not because prices are skyrocketing uncontrollably, but because the opportunity cost of capital has shifted so dramatically that inaction becomes an active form of wealth destruction. You must reevaluate your long-duration assumptions and prepare for a world where the baseline return on safe assets is both higher and more volatile than anything experienced in nearly 2 decades. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.